Hi guys, welcome back to Financial Markets. So it's been another turbulent week in the equity market, as I'm sure you all are aware, with obviously coronavirus now escalating day by day and week by week. There's a lot of fear in the global markets of whether or not people, want to own any sort of equities or any positions, to be honest. And obviously, there's two things to take notice of here. One, it's obviously the market's getting repriced based on, okay, there will be a slowdown in economy, there will be a slowdown. Obviously, people are going to be out of jobs. But also, you've got to understand in terms of market participants, right? There's also been a liquidation process that's happened across all global sectors. Because what's happened is people that have been laid off, they might have had some of their savings, say, in the equity market or in silver and gold and whatever, and so those people have had to just sell off their positions anyway, not because it fundamentally makes sense to do so, but because of the fact that they need to raise some cash because they're obviously out of a job. So a good example of that is silver. So if you see silver from 6th of March to about 10 days, so it's 18th of March afterwards, it collapsed, a huge amount. I mean, percentage of 30%. And fundamentally didn't make any sense, right? Because usually when times are of turmoil, you get people buying into gold and silver, but you've had big liquidations there as well, and that's just been a complete liquidity issue rather than a more fundamental driven issue. But the idea is when you see opportunities, like when you see times like this, you can sit out and then take advantage of the situation because there was a liquidity problem. So when people got out of the liquidity issue, then then you can get back in because fundamentally it makes sense. So something attractive like right now is definitely gold on that measure, because you had that same sort of liquidity issue here, but now you've had, okay, liquidity subsiding down a little bit, so people are going into the assets that make sense, and gold being one of the ones that definitely in the safe haven play does make sense. But so what I wanted to show you is, so if we have a look at the S&P now, the S&P is down, I think, about 25%. It went to as low as 35%. Now, if we go back, we're definitely in a bear market, that's for sure. So a bear market is considered as if a 20% drop from peak, which we obviously clearly exceeded, as I've shown you. Now we have a look over here, right? We dropped as much as 55 in the global financial crisis, but look, we fell 18, we had a bounce up by 10-20%, then we fell 20, we had a bit of a bounce up, then we fell 45, and we had a huge bounce up as well there. So these spikes continue and always happen, so you got to bear in mind that this does look very similar to 2008 crises. And if we go back to 2000-2001, which is also quite interesting, it's the same thing here. We had a big drop of about 50%. With massive, jump, so 12% big jump up, 30% drop, but then huge rally up, then a 37% drop and a huge rally up. So you get the idea. So these look really similar to these, previous recessions. So it could give you an idea of how to look and see, okay, well, how much do you normally get jumps of? You get jumps of about 20%, right? That seems about realistic. So it's just good to have an idea, right? I think double digits is usually a good way of knowing, okay, that's had a fair amount of jumps. So if you are bearish, these opportunities give you chances to get short the market. And now we've had how much of a drop? We've had how much of a rally? So we did get to about 20%. Yeah, it could go another 10, maybe more percent. Doubt it, but you just never know, right? So the idea is these markets are very similar to the previous recessions. I still think the market has a lot more to go down. The reason is, I think, because it's just not an economy issue, it's more of an issue with companies. So just to give everybody a background, so since 2016, I usually like to look at this level. Since 2016, there's been huge tax cuts and huge buybacks by companies. So that's actually added to the big growth on the equity market. So now when I'm seeing price at these levels, not even just in equities, in the index, but also in the equity pieces, you're actually seeing valuations that are still not at fair value, let alone discounting. So I'm just sitting and want to ride this out. So a couple of stuff that I think people should look at if you are having on the same boat that you can make, that you want to get a short position on, or you want to be negative against the market, is this. So in FX space, you want to have long dollars, long yen, and long Swiss franc. Reason why is because long yen and Swiss has always been a safe haven currency, so they usually rally in moments of crises, and long dollars say against currencies like EM currencies that are really already having weak, Korean won, Brazilian real, potentially some rubles, NOK, Aussie dollar, and Canadian dollar. So those are positions you would look to get to. So if they've had a big rally, so if you do have a look at, say, dollar NOK, right, they've had a big rally already, but they, the point is they had a big retracement as well, so you can take these opportunities to then get back in on those positions. So those are positions that you can play in the FX space. In the equity space, I wouldn't say just to go outright short, only because it's quite difficult to time markets, and when you have these bear squeezes like I showed you in the S&P, you could easily get wiped out your position. 10, 15, 20% move is a huge move. So the way you could do it is you can long a healthcare basket, and you could short companies with high debt. Healthcare, because obviously it's a coronavirus issue right now, and people are obviously researching companies, and healthcare companies are doing work on that, and so they haven't been too bad in terms of their performance. So if you have a look at Gilead, for example, it hasn't been too bad at all. So opportunities like going long Gilead and going short companies that have really high debt can play a very interesting combination trade as well. So let me know what you guys are thinking. Do you think this is the start of a recession? Are you going long the market? Are you going short? And what are your best trades so far? Anyway, hope you guys enjoyed this video, and I'll see you guys in the next one.